All right. Hello, everybody. Today, my name is Dre, and Jared and I are going to be going over how to buy your first house. We're going to be going over different loan options you can use to do so and how to get your credit up as well so you can put yourself in a good position to buy this house. So, this is Jared right here.
Hey everybody, it's Jared Roboski here with CMG Financial, and I'll be going a little bit after Dre, and we'll discuss some great ways to buy your first home.
All right. Thank you, Jared. So, let's get started. I want to start off with some success stories here. This is a client we had last year. And some home buying statistics on myself. So my sell to list ratio is 98.5%, which means on average I save my clients around 6 to 11,000 when representing them during the purchase of buying their property, whether it's their first property, second or third. On average, I get to save them about that amount on every house they buy. Then another story we got here is our lovely couple clients from last year. So they bought a house for 315,000 and sold it for 350,000, but they got a check at 95,000 at closing. So how is that possible? So whenever you buy a house, every time you make a monthly payment, that builds your equity in the property. So it's similar to if you're paying 2,000 a month for rent, and after a year, you pay 24,000. If you had an apartment and you left the apartment, you got a $20,000 check at closing, or not closing, but when you left the apartment, you got $20,000 back after you left. Wouldn't that be nice? But that's kind of how it is when you buy a house, because every time that monthly payment, you're building equity in the property. So it's kind of like you have a forced savings account that you're living in. So that's how that works. So when you buy a house and you sell it, you get the appreciation that you got on the property plus the equity built in the property. And that's how this couple got that 35,000 plus the 60,000 of equity they had in the property for a check for almost $100,000. And another family we got here, we helped out last year. So their credit was not the best when they first started looking for houses, but we were able to get them up to speed, get their credit up, and we got them a great deal on a 2-story, 4-bedroom house for under $200,000. That was only about 3 or 4 years old. They were extremely happy at the closing table, as you can see. So 8 steps to home ownership here. You'll decide to buy. You'll hire your agent. That is myself. I'm a real estate agent. I help people buy and sell properties. You'll get pre-approved by your lender. That is Jared, and he's great at that. Help people get their loan quick and efficiently. You'll find your house. You'll make an offer and negotiate. Perform due diligence. And you'll close on the house and protect your investment. And we'll go over all the steps more in depth here. So decide to buy. So financial net worth. Compared to the average renter versus buyer, the average renter's net worth is only $4,000, and the average net worth of homeowner is $184,400. That's quite the difference here. And so it's similar to if you pay $1,000 a month in rent for 30 years, you'll be paying $360,000 without ever owning anything. That's a huge waste of money, time, and effort, all together there. That's almost $400,000 they'll be spending and wasting. So yeah, not the best investment to rent an apartment for 30 years, as you can see here. Then to help you out with that, you want to contact an agent. So that is where I come in, and I can help you make money for living somewhere and making a monthly payment, which you're going to be doing anyway because you have to. So when you lease an apartment or when you lease a house per se, you're paying someone's mortgage either way. You're either paying the apartment owner's mortgage plus some because they have to make some money off you, right? Or you're paying the landlord or the rental property's owner's mortgage plus some because they have to make some money off you as well. So no matter where you live, you're paying somebody's mortgage, whether it's yours or whoever owns the property that you're leasing from them. Then decide to buy. So for a lot of people, a house is the largest financial asset most people have due to the equity and appreciation over time. The average annual appreciation rate, over nationally is about 5%, 4 to 6, and that's since 1977. So let's look at some scenarios here where it's a really slow year or appreciation just isn't going up much. So even at 3% annual appreciation, a home purchase for $150,000 would grow to $364,000 in 30 years, which is crazy. And even at 1.5% annual appreciation, this same house would still grow from $150,000 to $234,000 in 30 years. So those are some mind blowing statistics right there for you. And then, yeah, so we like to say when you own a house, it's like a forced savings account or an accidental investment. So it basically is an account you live in. It's like every time you make that payment on your mortgage, you build equity in the property. And a lot of people don't know this, but you can do a lot of different things with that equity you have in the property. So you can take some equity out to pay off some debt. So we had a client do that recently where he refinanced his property, took some money out and to pay off a lot of debts he had. You can take some equity out to invest in rental property or a second house. What do you want to do with that? I've even heard of some people taking equity out and starting a business with it. So just invest in your future, invest in yourself, really whatever you want to do with it. You can do, you have a lot of options with that equity that you build in your property. And then, yeah, so the main roles that I do for my clients is I educate them about the real estate market. I analyze all their wants and needs, and I steer them to homes that fit their criteria. I coordinate the work of all the other professionals, such as the title company, the inspector, contractors. I'm in constant contact with the lender, Jared. I do tons of negotiations on your behalf in terms of the price of the house, in terms of closing cost, dates, contingencies, and everything that entails. There's lots of paperwork that goes into this and any problems that may arise that I put out for you. So just during this process, fires typically come up that I put out, and a lot of times it's with the vendors, whether it's scheduling, what vendor needs to be at the house at a certain time and things like that. So I handle all this for you while you're working your job and don't have to deal with all this stuff at one time. Then you have finding your home. So when I have a buyer's conversation with my client, I like to ask them a high number of questions and just go really in depth in what they're looking for, what they want, because that can save us a lot of time. I like to say it's better to ask more questions so we don't have to see, 20, 30 houses instead of asking, just a few questions and then, seeing all those houses. So it saves both of us a lot of time and effort when I know what you really want, what area you're looking for, what type of house, stories, yards, everything like that. So I like to go really in depth, the conversation with my clients and everything. And then, yeah, so when we're looking at houses together, we're going to be looking at them from two different points of view. So, you're going to be looking at the layout, the space, the open concept, how's the kitchen, the living room and everything like that. I'm going to take a more objective view of the property. I'm going to be looking at how does this, price this house compared to the surrounding houses that are similar. Is it the same value as them? Did they overprice it? Where is that in terms of price and value and everything? What's the layout of the property? What's the condition? Are there any cracks in the corners? Do I see any mold or any, stains in the ceilings, anything like that? How does the roof look? How does the foundation look? Things like that. So, while you're falling in love with the aesthetics and how the property looks and everything, I'm taking a much more objective view, taking a step back and say, okay, this is actually good property. Is it worth the price they're asking for and everything that entails? So yeah, making an offer. The three main components of an offer are the price, which, must reflect the true value of the property. The terms, the 6 basic categories with the timing and financial conditions, which I'll go into more depth here in just a minute, and the contingencies. And most of that is the option period, and that gives you a certain time to back out of the contract or the property without any penalties on you. And that's really an important part of the whole process here. I'm going to go more in depth on this next slide. So yeah, so while all this happens here, so when you make, I'll go into the process really quick here. So when you make an offer on a property, we do the negotiation, the back and forth, and we agree on a price with the seller that you're going to buy at. We next enter into what's called the option period. It's typically about 8 to 10 days, and you pay for the option period because you have to pay the seller to take the house off the market. Because if while they're taking the house off the market, they could be entertaining other offers besides yours. So that's why you pay the seller typically $10 to $20 per day, depending. It's negotiable, like most of the things in this process. So 10 days times $10 is about $100 that you pay for that. But yeah, so during the option period, in those 8 to 10 days, we're going to get the property inspected and expose any structural or hidden issues with the property. And then the other two aspects of this coming more towards the closing, the insurance policy and the flood insurance warranties and all that. That's more of a closing thing. comes in at the end there. But yeah, so that option period though is when you're going to get the property inspected. You're going to see the inspection report, which is going to be pretty overwhelming when you first get it. Because on this slide here, what you want to look for on that inspection report are the major things like the foundation, any cracks are crumbling, cracks inside the house, the walls, the roof, anything like that, around the windows. Like I just said, stains in the wall, any mold or anything, faded or worn shingles, the roof, or any electrical plumbing issues. Because yeah, when you get that first inspection report back as a first-time home buyer, you're going to be overwhelmed. It's going to be about 40 pages long. There are going to be tons of items on it marked sufficient, because you got to realize, it's the inspector's job to let you know about every little thing that's going on with that house. If there's a simple scratch on the wall, they're going to mark the whole wall as deficient, or every wall in that room is deficient, because they really want to cover themselves, as much as they can. They want to get sued by you, the seller, or anybody else. They're going to cover themselves as much as they can. I can tell you 5 to 10 things I've seen on every inspection report for every house that I sell. So yes, inspectors are very thorough. Their job is to make you aware of every little thing going on with the property. And so in every house, has cosmetic things to be done to it, or every house has a little bit of wear and tear, because that's just, that's the reality of every house that you're going to see or possibly buy. Every house needs some small things done to it. Even new construction houses, there's always some small things that need to be done. So it's on every report you look at and you see, there are going to be some small things that need to be fixed, adjusted on it. So yeah, but when you get an inspection report back, the 5 major things are right here, what you want to look for. And y'all can take a picture of these slides too as well, if y'all like. Then yeah, so as we get closer to the closing table, the responsibilities that I will be handling for you include the appraisal, the survey, title search, and title insurance and everything. And then we're going to do a final walkthrough of the house as well. And typically we do that, a day or two before closing. We just want to make sure everything's so good with the property, that the seller didn't, scratch the walls up or do any damage if they already moved out already, anything like that. We basically want to make sure the house is like the last time we saw it, and a meteor didn't come through the house with anything, someone didn't accidentally drive to the house with their car. We want to make sure nothing crazy happens, since it might have been a few weeks since we've actually seen the property in person. And yeah, definitely want to make sure you keep yourself mortgage worthy. And Jared, do you want to speak on that really quick? Keep yourself mortgage worthy and everything?
Yes, for sure. What keeping yourself mortgage worthy means basically don't make any major changes. So when we pre-approve you, we're pre-approving you based on your financial standing at that moment in time. If you change things like go get a car loan or go buy a bunch of furniture or something like that, that changes your financial position. It's not that you couldn't do it. Some people can, but you definitely want to check with your mortgage lender. Check in with me before you make any major purchases after you've been pre-approved. That way we can make sure that you're not going to make yourself unmortgage worthy, basically. So just keep things the same while you're going through the process. Don't make any major financial decisions. And that's keeping yourself mortgage worthy.
Yeah, exactly. So yeah, just don't make any major financial moves without consulting me and Jared first while you're under contract for a house. So yeah, then next you're going to get your settlement statement, make sure all the financials are intact there, they're correct. Get the certified funds, evidence of insurance, and make sure your title is clear as well. And also when you get to the closing table, you're going to bring your ID, and as well as a check for the down payment for however much you're putting down on the property. And closing typically takes around 45 minutes, maybe even an hour, just because you have to sign so much paperwork, and the title rep will explain that paperwork to you as well. So that's typically the closing process in a nutshell there. And then yeah, you definitely want to protect your investment. What that entails is really keeping it clean, doing maintenance on the property, and just really watching out for what's going on with your house. Do a walk around to the house, at least once a month or so. Check the outside, get a good look at the roof. Just make sure everything's good with your house. If you see any signs of leak damage or wear, definitely want to address that as soon as you can, because fixing small problems early can save you a lot of money later on. If you spend a little money to fix a problem early, it could save you $1,000. Having to pay $1,000 later on if the issue gets bigger and bigger and more worse over time. Then another small tip is keeping a file of the receipts for all the repairs and upgrades you do, because when you put your house on the market to sell it, and you say, oh, I spent this much money on upgrades and repairs, all the buyers are going to say, okay, that's great. Well, can you prove it? And if you can't, then you don't send out at all to other sellers who don't have any proof how much they spent on those repairs and upgrades. But if you keep a file of your receipts and you upload them, into a document and attach that to your listing, the buyer will say, "Oh, this person actually spent $20,000 on all the upgrades and repairs they did." So yeah, so it's definitely a great way to stand out compared to other sellers that are selling the property in your neighborhood. Then yeah, so how to make money off your real estate investment or the house you're living in. So, if you have any friends you stay with on the weekends, or a significant other or family in the area, like you go see or stay with on the weekends, or if you travel a lot for work and you'll be gone for a week, 4 or 5 days or anything, you can definitely Airbnb your property out. And this is just a kind of a picture here to do some simple math. So if you wanted to rent your property out on the weekends, and typically Airbnb prices are higher on the weekends. But if, say, you just charge $100 for Friday night and Saturday night during the weekends, so 4 times a month, that's $800. That's a good chunk of mortgage that could be paid off too, with having someone else rent your property out while you're not there, just because you're staying with your friends, family, or significant other, something like that. So definitely a great real estate investment. I know people that are buying properties right now just to Airbnb them out. So it's definitely growing in popularity among real estate investors and people that own houses too. It's just a good source of extra money and extra funds to have. And another way is house hacking. We're seeing this as a growing trend. People that own houses, or people that are buying houses, especially with millennials and everything with that. So what house hacking is when you buy a property and say you have 2 friends that are currently renting, and you tell your 2 friends, oh, if y'all want, y'all can come live with me if you have a 3-bedroom house. So, and then you can split, the mortgage 3 different ways. So if the mortgage is about $1,500, you can each pay $500 a piece, which is an extremely low mortgage payment. I don't know any apartments these days that rent out for just $500 a piece as well. So that's a great way to save some money, to make your payment very low, and also your friends will really help you pay off the mortgage for you. So, excuse me. Every time they make a payment, they'll be helping you build equity in your property as well. Like I said earlier, one of the main ways you're gonna make money off the house is the equity you build up in it every time you make that monthly payment. So yeah, it's just a great way to make some extra money when you own a house and decrease the amount you have to pay monthly. And all right, so that ends my portion of this seminar here. So now I'm going to hand over to Jared, and he's going to talk about the loans, the credit repair, and everything that entails. All right, Jared, go ahead here.
Okay, hey everybody. We're going to talk a little bit about getting pre-approved. So we'll go to this next slide. And my name is Jared Roboski. I'm a senior loan officer with CMG Financial. I've closed hundreds of loans and top 1% loan officer here in Texas. So you feel free to reach out. I'm happy to help you throughout your entire process. Me and my team are going to take care of you from beginning to end and post-closing. I'm also going to keep up with you after the closing just to make sure you're in the best financial decisions, and I'll make you aware of any opportunities to save money down the line as well. So let's get into it. So pre-approving your loan. It's very important to know your buying power before you go shopping. And this is because time is money, and it's going to save you a lot of time to know your buying power before you go shopping. And so we're going to have a consultation, and we're going to find out what's a comfortable monthly payment range for you, because that's the most important thing, is knowing your monthly payment and making sure that that's a comfortable price for you to pay on a monthly basis. And then after that, then we'll come up with the price range of homes that you should be looking at to keep yourself in that comfortable monthly payment range. Because what happens if you just go straight out and look at houses is you're going to start to fall in love with houses you can't afford. We all do that. Of course, we want the big multi-million-dollar house, but it's not financially feasible for us to, overextend ourselves. And it's not fun if you overextend yourself. You want to make sure that you're making a good investment and not overspending. And now what I say with quality matters is means the documentation that we're collecting up front. We want to make sure that we're doing a full and thorough pre-approval. If you go to a lot of banks, what they're going to do is pull your credit report and get you to do an application, and then they're just going to go off of whatever you put in the application. The way you calculate income and the way an underwriter calculates income could be different. So we want to make sure we're giving you the highest quality pre-approval. So you go out there with the certainty that when you get your offer accepted, you know you're going to close on that house. Okay. And then the complete documentation depends on whether you're employed with a company or self-employed. But basically, we would collect some income and asset documents. Your income documents are going to be your W-2s, your recent pay stubs. If you're self-employed, we'll need 2 years of tax returns, and then 2 months of your most recent bank statements, along with your ID, and that will give us the information we need to pre-approve you for your loan. And then this follow the checklist is, I have a checklist, both in, Dre and I have a phone app, and we have a checklist built into the phone app that can help you. And then I also have one on my website, and if you do it online through a computer, there's another checklist there. So we're gonna help you throughout the process to follow that checklist, and it'll make it really easy for you to know that you've got the proper documentation in. Okay, and then we're going to talk about major loan type here, conventional. This is the main loan type that most buyers use. It has a minimum of 3% down. There's some great first-time homebuyer programs and conventional loans that allow you to do 3% down. And it also has a reduced mortgage insurance on it. There's Fannie Mae and Freddie Mac programs for first-time homebuyers. And there's also, you can match these up with grant programs as well. So we can get you a little bit of grant money plus a low down payment, and ultimately bring your cash to close down very much. And Dre is excellent at also negotiating the price down or getting you seller contributions. So we'll all come in together as a team to get your closing costs down and get you the best deal possible. Conventional loans go up to $510,400. So that covers most properties. If you needed to go over that, we can discuss. And there's jumbo loan products, and we can talk about those in person or over the phone. Credit score dictates your interest rate. So it's very important that you keep your credit score as high as possible. In the mortgage world, anything over 740 is considered excellent, and that will get you the best rates possible. But we can do conventional loans down to a 620 credit score. So don't be discouraged just because your credit score isn't perfect. We can find a program that works for you. And I do want to take a second to say that most banks are changing their minimum credit score requirements. Most banks have gone up to a 660 or 680 credit score. So we are not changing any of our guidelines. We recently talked to our CEO, and he said he has no plans to change the guidelines. And so we're still going to be doing these loans down to 620 credit score. So it's very important. Get with us early, and then we can set you up. We're going to be one of the easiest banks to get approved through during these times, because many banks are getting more strict with their guidelines. And so let's go to this next slide, and we'll talk about the FHA loans. So FHA loans are fantastic. They're the easiest loan to qualify for, and we can go down to a 580 minimum credit score. Now, it's a lot easier to get done when you're over a 620. There are some overlays. If you're between a 580 and a 620, we'll have to clear up some. If you have any collections, we'll have to get those cleared up. But just know that we can get you approved all the way down to a 580 credit score. And then on the FHA loan, the seller can pay all of your closing costs up to 6% of the sales price. So this is a fantastic loan. You could literally come to closing with no money down. And these programs also match up really well with down payment assistance programs if you need them. There is a lot of misinformation out there saying that down payment assistance programs have stopped. That is not true. Just many banks have stopped doing them because actually banks lose a little bit of money when they do down payment assistance. Just know that we are not canceling our down payment assistance programs, and I still have all 3 of the major programs, so we can help you out. We've gotten a buyer. Dre and I recently had a buyer we did with the down payment assistance program. She was owed $1,500 at closing. So all she came to the table with was she put her earnest money deposit and paid for an appraisal. And then we owed her the money back at closing, basically, because we got her so much down payment assistance. And then we closed another one right after that where they got $800 cash back. So these are fantastic programs to help you get you in your first house. The FHA also has a minimum down payment of 3.5%. And it has a safety and a value appraisal requirements. So the appraisal requirements, they go in and appraise the home. They tell you what the value is, and they make sure that the home is safe and that the appliances and everything are working. And this one has a maximum loan amount of $331,000. So that still covers most of the properties in Houston. So it's a fantastic loan, especially if you're a first-time home buyer, because of the low down payment and the lower credit score requirements. So if you have any questions about this loan, give us a call. We'll be happy to set you up. Also, there's a monthly mortgage insurance premium on this loan. It's 0.85% monthly, and there's a 1.75% upfront premium, but you won't have to pay that. We roll that into the loan. So that'll be rolled into the loan, and you won't have to pay that upfront premium. That's what pays for the FHA program right there, that mortgage insurance. And then we'll go cover this next slide. We're going to talk a little bit about mortgage rates, where they're going, and why is it a fantastic time to buy. So what we're seeing here is rates were all the way up to 4.5. They did actually go up to 5% there for a little while at the end of 2018 and early 2019. And then we've had a downtrend ever since. And now we're at the lowest rates in history, and they're bouncing around anywhere from 3.25 to 3.75%. And there's some volatility in the market. As you can see with the stock market, it's having some pretty large moves daily. The same thing is happening with rates. Just know you have a professional here, and I watch the markets very closely. So I'm not going to lock you in on a day where the rates go up. We would just be patient and lock the rate when it comes back down. So this is why it's such a fantastic time to buy, because we're below the lowest rates in history right now. We're literally at the lowest rates in history, so it's never been cheaper to borrow money. And then let's talk about home price appreciation. So home price appreciation is how much value your home goes up in any given year. So we're looking at the appreciation over the last 5 years for all 50 states. The one I want to focus on is Texas, because that's where we live. Texas has some amazing appreciation over the last 5 years at 37%. Now, what's that mean for you? That's 37% on a $200,000 house. In 5 years, we're looking at $74,000 in equity. You heard that right. $74,000 gained on a $200,000 house. Now, mind you, you're not putting up $200,000. This is a house that you could have got in for 3 to 3.5% down. So you may have only put down $6,000 or $7,000 to buy this $200,000 house, and 5 years later, you're going to have $74,000 in equity, and that's just from price appreciation. As Dre said earlier, you're also going to be making money by paying down the mortgage. So you're really going to come out with a lot more than $74,000 over that 5-year term. So that's why it's an excellent time to buy, and you're investing in yourself and you're investing in your future. Now let's go to this next slide here. And this is your housing wealth equity gains. Now, this tells you how much equity you could gain over a 5, 10, 15, or 30-year period. And this is based on your price appreciation, your principal payments, and then your total gains. So as you see, in 30 years, you will have paid off the house. It will have appreciated in value. And then also, so your total gains would be about $243,000 if you would have purchased that house 30 years ago. So as you see, average house 5 years ago, these are national averages. So you'll see it's a little higher than 74,000. You're going to be gaining 79,000 in about 5 years. If you bought a house 10 years ago, you made $91,000 already. 15 years ago, $124,000 already. So that's why it's an excellent reason to buy, because you're going to be gaining wealth over the time. And we can go into that on the specific properties. And we're going to go a little bit into credit 101 for home buyers and why credit is so important. So we'll check out this next slide. and it's going to tell you a little bit about how your credit score is made up. Vantage score versus FICO score. So the apps you use on your phone or your Credit Karma or any of those, they're good credit monitoring, but they're just pulling a Vantage score. So that's why it's not going to be accurate compared to what a mortgage banker pulls, a FICO score. So your FICO scores are made up from 30% of the amounts owed on your credit line. So that's your credit to debt ratios. And then 35% is payment history. So that's very, very important. 65% of your credit is how much do you owe and are you paying on time? Very, very important. So keep your balances low on your credit cards. You want to keep them below 30% for sure. I always recommend keeping them below 20% to maximize the benefit of increasing your credit score. 10% is new credit. 15% is length of credit history. That's why you don't want to close old accounts, because your length of credit history definitely does help your credit out. And then 10% is a credit mix. So credit mix means maybe having a credit card, a car loan, and a house loan. That's going to improve your credit score to have multiple different loans. I'm not saying go out and add a bunch of credit cards, and I'm not saying go out and finance a car. You definitely want to finance the most important things first, and most important would be investing in yourself, meaning buying yourself some real estate, because that's going to appreciate in value where a car only depreciates in value as you drive it. So very important. And we can go into this on an individual basis when we have a consultation on how to boost your credit score to maximize it. Now we're going to talk a little bit about building credit. You can build credit with secured credit cards. If you don't have any credit, you can go through, there's some big ones, Credit One and Capital One have secured credit cards where you will pay an initial payment of $300 or $500 to get yourself a $300 to $500 credit card. And then you use those same percentage ratios. So if you have a $500 credit card, don't put over $100 on there. You're trying to build credit. It's not really to use the credit. You're just trying to build it. And then eventually you'll get your credit lines increased. If you already have credit cards, if you had some issues paying it or you have any issues in the past, what you can do is get added as an authorized user on a family member's credit card. And you don't even need a copy of the card or have the ability to be able to use it. All you need to do is be an authorized user on somebody's credit card. And then what that'll do is that'll get you all of their credit history. So it'll instantly boost your credit card. Okay. And then let's go to this next slide. We're going to talk about strategies. Don't pay off old accounts. As we saw earlier, old accounts help you. The age of the account increases your credit score. So don't pay those old accounts off. Definitely not without talking to me. You don't want to close any old accounts. You can be added as an authorized user, as we discussed in the slide before, and you want to keep your balances below 20 to 30% of the credit limit. If you have a $10,000 credit limit, that means keep your balances below $2,000 to $3,000 and monitor your credit. I always recommend paying them off every month and keeping the balance well below 20%. But those are the best tips for you to boost your credit score. And we're going to talk a little bit about credit reporting, credit repair, Fair Credit Reporting Act, and challenge inaccuracy. So sometimes there's inaccurate data on your credit report. Sometimes they may show that you missed the payment when you actually made the payment. So you can challenge inaccuracies, and I can help you do that. There's ways to do that through the credit bureaus. And then if you need any further help with it, then we have credit professionals that we can send you to, and you can hire a credit repair professional. But I always suggest you can do most of this by yourself and on your own. So that's basically how you buy a house, how you get a loan, and how you can get your credit to the best position to be able to afford the house that you want and get the best interest rate possible. And Trey, you want to close us up?
For sure. Yeah, so we're glad you joined us today. Yes, in a nutshell, we went through the process of how to buy a house from beginning to end, different loan types you can use, and also how to get your credit up, best ways to check it, monitor it, and improve it. And yeah, so here's our contact information, mine and Jared's. And we can send this presentation out to you through email. So if you want to text us, call us, or email us, here is our information. And I'll leave it up just for a minute here before we have to close the presentation out. But yeah, we're definitely welcome to any questions you have, whether it's through the home buying process, the loan application process, or credit as well. You can just give us a call, text, or email, and we'll be glad to help you out with that. And yeah, so with that, we want to thank y'all for coming. Feel free to take a picture of this last slide as well if you'd like to save our information. And yes, and one last thing is we're going to be doing these virtual seminars here twice a week. So we're going to be doing them every Saturday and Sunday. They should be at the same time. Every time it should be from 1 to 1:40 every Saturday and Sunday. That is our plan going forward here. And they should all be through Zoom as well. So every time we do these meetings, I will have the link posted on the app for y'all to see and follow. But yeah, with that, I'm going to end the presentation now, and we appreciate you joining us for this. Have a great day and stay safe out there.
Real quick, just in case you didn't see, if I didn't get a chance to cover a lot of different loan products, and the reason why is because there's literally over 100 different loan types. So we just covered the basics of a conventional and an FHA loan. That doesn't mean that's all we have. We have VA loans, we have jumbo loans, down payment assistance loans, and they come in all different formats. So we're going to structure the loan to fit you, to make it work for you. So give us a call and we can get started. Thank you so much.
All right. Thank you, Jared. And with that, we'll end. And yeah, reach out to us any questions you have. Appreciate it.